Oh sheet, ladies and gentlemen, welcome back to the channel. Fitch puts the United States AAA rating on negative watch, citing debt ceiling fight. Holy guacamole, what in the world is going on? This has only ever happened, well, I should say a downgrade, has only ever happened one time before. And what if I told you that Fitch warned about a downgrade, even if the debt ceiling was raised back in March of 2023, over 2 months ago? Ladies and gentlemen, we need to get into what is going on with this current situation. How could this affect the markets? How could this affect potential margin calls or collateral crisis? Or could this just be the end of this bull market as we know it? Let's get into it. Ladies and gentlemen, welcome back to the channel. I hope you guys had a fantastic day, having a fantastic night so far, no matter what time you're watching this video. This information is paramount of importance that you fully understand the implications that are here. So let's dive into it, guys. Fitch. They've been warning about this for a while, and the markets really have not cared for a while. Okay, now they might start to care a little bit more. And we'll talk about what a negative watch is, but what did Fitch just say about the United States that especially has me a little bit more, not on the worried side because, you know, we're hedged out for this kind of situation, but more so on the excited side, maybe. If you have positions in AMC, if you want to see collateral dry up, potential margin calls, should be a pretty exciting thing, but hopefully we don't default. We obviously don't want to default. No matter how bearish you are, you don't want to default. You're talking about millions of job losses at that point. But Fitch says, the rating watch negative reflects increased political partisanship that is hindering reaching a solution to raise or suspend the debt limit despite the fast approaching X date, the rating agency says. If we go down here to what it says, quote, however, we believe risks have risen that the debt limit will not be raised or suspended before the X date, and consequently that the government could begin to miss payments on some of its obligations. They're just straight up saying the government could default here pretty soon, and they are worried. Now, this is what I find very interesting. This article came out March 6th of 2023. So March, April, May, almost 3 months ago. It says America's credit rating could get downgraded even if a default is avoided, Fitch rating warns. Now, he says every few years, Washington plays a dangerous game of chicken over whether to raise the debt ceiling or default on U.S. debt. Even if a default is avoided this time, the frequent nature of these political showdowns could cause America's credit rating to get downgraded, Fitch Ratings told CNN on Monday. Quote, we are more concerned this time around, James McCormick, Fitch's global head of sovereign ratings, said in an interview. This was in March. You are 7 days away from a default, and they were saying this in March. Okay? They go on to say America has a perfect credit rating from Fitch and Moody's. One guy is left out there, and that is Standard & Poor's. But not because of its fundamental finances. Those already look messy and were at the heart of the unprecedented credit rating downgrade by S&P Global Ratings in 2011. America's mountain of debt and interest costs have only worsened since then. Instead of fundamentals, the AAA rating is really based on America's preeminent status in the financial world. The US dollar is the global reserve currency, and US treasuries are treated as risk-free assets in the minds of investors, two characteristics that give the United States unrivaled financial firepower. But McCormick warns that repeated episodes, like the ongoing debate over raising the $31.4 trillion debt ceiling, chip away at those two things. The closer closer the United States gets to the X date of actually running out of money, the more investors are forced to confront the unthinkable, a disastrous debt default. Quote, when investors have to think about that, that's not what you're looking for in a risk-free asset, right? McCormick said, adding that people may want to reassess whether treasuries really are risk-free. Boom. I mean, I couldn't have said it better myself. I don't think anyone could have said it better themselves. Are treasuries really risk-free if every couple of years we're days or hours away from a default? Is that narrative of a risk-free asset really belonging if that's what keeps happening almost every couple of years? Now, quote, if the market reaction is to call into question the role of the dollar in the future as the world's reserve currency and the treasury market as the world's risk-free asset, then absolutely we could, he says. And it goes on to say that the United States will likely start to default on its obligations over the summer or early this fall if Congress doesn't address the debt ceiling by then, according to an analyst released date last month by the Bipartisan Policy Center. Keep in mind, this was back here in March. Asked if Fitch could downgrade the United States even if a default is avoided this time, McCormick said it would depend on the reaction in global financial markets. Now, this guy that said this is the head of sovereign ratings for Fitch. This guy is the guy that would downgrade America if there was a downgrade coming. Not good at all. So, what is a negative watch? Let's start with that. A negative watch. And what does an ultimate downgrade or default actually do? Like, why is it such a bad thing? Well, a negative watch is when one of three major credit rating agencies places a company on negative watch. It indicates that the agency has noted a circumstance or circumstances that might cause it to downgrade the company's credit rating in the near future. It is not a sure thing. Once a rating agency places a company on negative watch, there is a 50% chance that the company's rating will be lowered sometime in the next 3 months. So with something like this, it doesn't necessarily have to be in 3 months. It could be in 24 hours where a downgrade actually happens. Keep in mind what Fitch said in March, that they were already, thinking that we might get downgraded. So 7 days till a default. I mean, I would argue the probability of getting downgraded here by Fitch is higher than 50-50. I would think it's like 80-20 at this point. Just granted what we heard back in March. Now, what happened the last time we actually did get downgraded? Because Moody's has never downgraded us, Fitch has never downgraded us, but S&P did. So if we take it to the charts, we've talked about this before on the channel. So if you guys are, viewers of the channel and you guys watch most of these videos, at least you've heard this before. But back in 2011, on August 5th, America was downgraded from AAA to AA. And what happened in this period in time? The markets had been falling because people were worried about the debt ceiling. You were coming down to the wire at this point. Well, on August 5th, you were downgraded. The markets were actually flat. They were negative 0.16% on August 5th. But this news of a downgrade came in after hours. This came at nighttime. So markets were not trading. And this was a Friday. You opened on August 8th, 2011, down 6.5% on the S&P 500. So it was not a good time for the markets when we got downgraded. And that was only a downgrade, let alone an actual default. I don't think we're going to default. I don't really think that's an option, right? That would be like almost like financial suicide. Now, what does a downgrade do, or what does a default do? Now, both of these things affect the treasury market, right? Now, let me put this into perspective. Have you guys ever heard of a term called a dividend trap? A dividend trap is a company that pays 10, 15, 20% dividend for a period in time that is unsustainable. Whether that is their share price has fallen a lot or the company's in financial trouble, whatever the reason is for a high dividend payout, a high dividend payout tells you that there is risk there. Because why wouldn't anyone, just any old investor, go out and buy a 10% dividend stock if it was a safe company? If Coca-Cola was paying you 10%, well, people would go out and buy the stock so much that the dividend yield would go down, because dividend yields are fixed. So just for simple math here, if you had a $100 stock and you got paid out, call it $1.25 every quarter, you got paid out $5 a year, your yield would be 5%. Now, if investors thought that was not a good stock anymore, or for whatever reason, say the stock fell to $50 and you're still getting paid out $5 per share. Now you're at a 10% dividend yield. But why would you get to a 10% dividend yield at all, right? Your stock would have had to fall a lot. So it's telling you there is risk embedded in that dividend yield. Well, if America gets riskier, that means credit's going to become more expensive. It has to. The riskiest assets have the highest yields because they have to. They just have to. That's why if an investor invests in Brazilian government bonds, they get paid a lot more interest because there's a lot more risk that you might not get paid or you might lose all of your money. Whereas in America, it's deemed as a risk-free asset, so you get paid now, 3 to 5%, depending on where you are in the yield curve, because you're gonna get paid, right? If there is this notion that maybe America's not risk-free anymore, maybe there is risk, and maybe we won't get paid on our yield on our bonds, well, the yield is gonna have to go up. That affects credit lines, that affects mortgage rates, that affects credit cards, that affects auto loans, that affects the cost of capital, that brings down equity valuations. Lots of reasons there that would be negative. Just imagine this. I was thinking about this earlier today. I'm like, if we did default, why would we lose 7 to 10 million jobs within 2 months? Well, if you think about it, what about home builders, right? If mortgage rates all of a sudden went to 10 or 15%, mortgage demand's gonna all but dry up. People aren't gonna go out and buy a house. Those builders are no longer going to have jobs. Think about an auto market. Think about people that work at GM or Ford. If you were to default and now getting a loan on a car is 30% or whatever interest rate, it jumps up. Let's just say it doubles. There's not going to be that many people going out and buying cars all the time. So that's going to put a lot of those people out of a job. And there's really a whole trickle down effect to when you get downgraded, or when you do, if you do actually default. So it would be very negative for the economy, for the markets. Even just an outright downgrade like Fitch is warning would be very negative for the stock market. Now, for AMC stock specifically, it could benefit in terms of getting to a short squeeze maybe a little bit quicker, because at that point, credit's going to all but dry up. Hedge funds, banks, everyone's going to buckle down and really try to tighten up their capital. They're going to want to get their capital back. And when you got to put up capital as collateral for things like short positions, really good way to get some money is to cover on that short position and take your collateral out. And I think that's a possibility, but I think even better yet, if AMC were to catch a bid at that moment in time, or, actually see a bullish catalyst, that could exponentially rally AMC stock for the same reasons that Volkswagen squeezed at the lows of 2008. That's just how these things work. So I do think on that, front, this warning from Fitch is potentially very good news for investors in short squeeze trades. On the other hand, for the broad markets, big red flag of some pain to come. Now, this is all coming, coincidentally enough, after Nvidia is rallying over 24% in after hours, going up $75, blowing past their all-time highs by like $50. It's actually insane. But Nvidia's earnings were insanely good. Their EPS was $1.09 adjusted versus 92 cents expected. Revenue of $7.19 billion versus $6.52 billion that was expected. But it's really all about the guidance. Nvidia said it expected sales of about $11 billion, plus or minus 2% in the current quarter, more than 50% higher than Wall Street's estimates of $7.15 billion. Nvidia just guided up over 50%. Nvidia just guided up about $4 billion. The original estimate was $7 billion total. That's insane. If Nvidia can pull that off, props to Nvidia. Maybe the AI bubble is here to stay for a while. And this AI bubble has really affected your largest companies in the American stock market. Google, Amazon, right? We went over this spiel many, many times. I'm sure you guys are sick of hearing it at this point. So all of those stocks caught a bit at the same time. Nvidia never really affected the markets broadly, but now they are because of AI. So that's why the NASDAQ is up, or was up 1.5% in after hours. We'll see what happens once we open for trading. If you do get a, buy the rumor, still sell the news event on some other stocks, maybe your Microsofts, maybe your Apples, maybe your second tier guys. I think Nvidia is going to be a little bit stickier. I think they're going to hold some of those gains with a guidance boost like that. I would be very surprised if Nvidia gave up a lot of the profits that you've seen, or the gains, I guess you should say, in after hours, guys. But really weird push and pull here. You got a lot of economic data coming tomorrow. You got a lot of economic data coming on Friday as well, especially with those retail sales, personal spending, personal income. Or no, it's personal spend, no retail sales. Personal spending, personal income, and core PCE that come out on Friday, guys. So that is going to do it here in this video. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. If you guys do want to come trade with me live in real time, link down below in the description of this video. Thank you for watching, and I will see you in the next one.